Welcome back. You're still with us on Markets Today. Well, let's run you through the remainder of the headlines that we're tracking for you. The fourth headline now, crude oil prices remain on a tight leash. Brent crude continues to hover around the $85 mark. Oil prices are slightly under pressure today after the larger than expected surge in US inventories. Manisha Gupta, she's on top of that. She joins us to fill us in with more on those. Manisha?
It's a sharp cut for the crude oil prices. We are off from the 3-week highs of $87 a barrel that we saw on Monday itself, and the prices have declined by 3.5% in this week. Three things really to look at. One is the U.S. crude inventories, which have gained up by 10 million barrels. This is going to be an 8th straight week of gain in U.S. inventories. Second is that the U.S. has said that after selling 180 million barrels last year from the Strategic Petroleum Reserve, they are looking to sell further 26 million barrels now. And the third thing is the EI report, which says that the U.S. shale oil output will hit a record high in the month of March. So the markets are looking at higher supplies, but there are concerns about demand right now. Interestingly, the OPEC monthly report says that in 2023, they are expecting a decline in production from OPEC and non-OPEC. But when it comes to demand, they're expecting an increase of 2.32 million barrels per day. So strong demand expectations, but from the next quarter is something that the street will keep an eye on.
All right, Manisha, but stay with us. The metal space as well was in focus. Non-ferrous metals saw a bit of a price dip due to the stronger dollar index. Tell us more.
Yes, another day when we have seen decline in base metal prices continue. The last couple of weeks actually have been quite difficult. We've seen profit taking coming in from China and on LME as well. We know when you look at the month of January, the LME metal index was up by nearly 10%, but February has seen a bit of a pullback, and until now the LME index is now up by just about 3%. The profit taking also comes in on the back of Chinese demand, where there's a big question mark on whether it would be sustainable or not. When you look at the inventories, and while of course they started with the lower base, but where we were on 1st of January and where we are on 15th of Feb is a big difference, because we have seen inventories almost jump up to double for many of these metals. For example, if you look at aluminum, the inventories on 1st of Jan were at 95,000 tons. They stand at 268,000 tons now, and that pretty much is the case, as you can see, in Shanghai copper and Shanghai zinc stocks as well. Even lead stocks have almost doubled in the matter of last 1.5 months. As I said, inventories have risen from a very low base, because the copper inventories were at the lowest in a decade in last 18 months. We've seen aluminum inventories at the lowest since 2016. Zinc inventories were the lowest in last 90 years. So the buildup in inventories is not so much, but that does tell you that the demand isn't really picking up on ground. The prices as well in the month of Jan, many of these metal prices were up anywhere between 8 to 20%. But in the month of Feb, we've seen 6 to 12% of a decline come in for many of the metals. So when it's about the non-ferrous metals, the profit taking is quite strong. Can't say the same about the ferrous metals, because steel and iron ore prices do continue to trade in positive.
Okay, all right. Thanks a lot for that, Manisha. Well, the fifth headline today, inflation in the United States remains stubborn. The consumer price index was expected to rise by around 6.2% in January, but data shows that inflation has risen by around 6.4% compared to last year. Even on a month-on-month basis, inflation was higher by close to around 0.5% odd. Core inflation, which discounts the volatile food as well as fuel prices, has risen by around 5.6% against an estimate of around 5.5%. Earlier today, we spoke to Matt Orton of Raymond James Investment. Let's hear out what he had to say about this data point.
It's positive that we continue to see inflation move lower. I think you can't deny that everything's moving in the right direction. But where I think the market continues to miss the mark is in expecting that the Fed isn't going to keep its foot on the brakes for a longer period of time. We've talked about this before, that higher for longer is going to remain the thesis. And bond markets have started to come around to that. Bond market pricing is much closer aligned to what Fed guidance has been. I still advocate remaining more defensive in your core positioning, leaning into quality companies with higher free cash flow, earning stability. It hasn't been rewarded this year, but it's been rewarded for the past 9-10 months. And I think that's going to continue to play out as the equity markets start to move into agreement with the Federal Reserve as well. I think the Chinese trade, while I think it has legs, medium, longer term, I think the Chinese market is definitely overbought. And I think that's why you're seeing some investors start to rotate out of China putting some more money to work in India. If you remember around the scandal and the news flow that came out around the Adani Group, I think China benefited from foreign money continuing to chase that reopening trade higher. You're starting to see a reversal of that, but the reopening theme still has legs to go. And that's why when I look at Asia more broadly, I think India is much more independent from the Chinese story.
Okay, all right. Well, on that optimistic note, we'll wrap up on this edition of Markets Today. Thanks so much for watching.